Is it enough for the markets for the Fed just to continue to say lower for practically ever, or does the Fed need to move toward outcome-based guidance, average inflation targeting, et cetera, for the markets to be satisfied and continue this rally?
Well, there's the old saying that when something becomes a target, it's no longer sort of a good measure or something to focus on. So we've had a problem targeting inflation for a long period of time. And I think at the zero bound, we've kind of run to the end of monetary policy. So I think the fiscal supports were really important during this time from governments around the world, whether that was on income support or other things like that. And I do think that as long as large swaths of the economy are still shut down, I think it's important at least to extend some of those supports until the economy can come back. And so I think that's why, there's such a push to extend some of these programs, at least hopefully until year end. I know the House is debating things, but those are important. I think, monetary policy is probably can remain supportive of conditions, but to get through this great contraction induced by the pandemic, we probably still need fiscal supports for a little while longer. And so I think, the market is nervous, certainly into this month, about the expiry of some of these things for sure.
How much further can the Fed's tremendous liquidity in the markets get us in terms of this market rally? Or have we already seen, I know that you've been invested in the cloud area for more than a decade at this point, but certainly that is an area that's really gone up, in part because it's perceived as work from home, but also because there's tremendous liquidity out there in the system. We've seen cloud stocks, for instance, the BVP NASDAQ Cloud Index up 55% this year. It's just been tremendous runs here. So how much of that is just there is no alternative, plus the Fed's liquidity?
Well, I think to some extent, obviously, this entire contraction was government induced, right? We shut the entire economy down. And I think there was a couple of papers that were written likening it to sort of a Katrina type of event, where you have a complete shutdown of the economy and then you sort of see the V rebound. And markets are always forward looking, so markets are going to anticipate that recovery. And so, I think that this was not something that was an economy that sort of rolled over because of natural causes, whether that was too much supply or a central bank raising rates too far. This was something completely different. So we've seen what it required to get over the hump, though, was obviously the monetary and fiscal stimulus. So, but I think you're beginning to see the early signs of a rebound. I think that, obviously technology has done well, but work from home and digital transformation are not the same thing. This isn't VPNs and video conferencing. What we're talking about are, cloud-hosted applications, whether it's subscription or volume-based type of models. A lot of that digital transformation was occurring before this pandemic and is likely to continue after this pandemic, whether that's because it's better and easier and more efficient to run, or just from a business continuity standpoint, or whether now you're at this third stage of the cloud where applications are being developed in the cloud that you could never develop on premise. Mm-hmm. So it's been a long-term trend that I think is continuing. I think the business model has really been played out, that it's not, try and sell as much software you can by the end of the quarter. This subscription-based model really held up well through this pandemic. And I think, that sort of proved its mettle. But as you expand across this market, we saw an unbelievable quarter last night from FedEx where they nearly doubled the expectations, right, despite higher COVID costs. So, you hear a lot from the bears about this bubble and that bubble. And, we had a 10% correction in January to February of 18. We had nearly a 20% correction in the fourth quarter of 2018. We had a 35% correction in March of this year, which was pandemic induced. So I'm not sure if they're waiting to tell you to buy the next correction, which will be 50%. But I think to sustain the move, you have to have the earnings. And when you see quarters where companies like FedEx, despite COVID costs, nearly double expectations, it's probably going to be E-led from here rather than PE expansion. Right. But there is a lot of operating leverage in the system. And I think that's going to require the economy reopening and people willing to re-engage.